Do you ever wonder how some people seem to be able to grow their wealth effortlessly while others struggle to make ends meet? The answer often lies in the power of investing, particularly in the stock market. But where do you even begin? Investing can seem like a daunting and complex world, especially for beginners. That's why today, we are going to guide you through the basics of how to start investing in the stock market as a beginner. Why invest in the stock market? Before we dive into the nitty-gritty of investing, let's address the most fundamental question. Why should you invest in the stock market? Well, here are a few compelling reasons. Beat inflation. Have you ever noticed how the cost of living seems to be constantly rising? That's inflation at work, slowly eroding the value of your hard-earned money. By investing in the stock market, you can potentially outpace inflation and protect the purchasing power of your savings. Over the long run, the stock market has historically outperformed inflation, making it an effective hedge against rising prices. Grow your wealth. While traditional savings accounts offer minimal returns, often struggling to keep up with inflation, the stock market presents an opportunity to grow your wealth over time. By investing in companies with strong growth potential, you can benefit from their success and potentially earn substantial returns on your investment. Historically, the stock market has delivered average annual returns of around 7 to 10%, providing a powerful way to build long-term wealth. Diversify your portfolio. Investing in the stock market allows you to diversify your portfolio, reducing the risk of having all your eggs in one basket. A well-diversified portfolio can help mitigate the impact of market fluctuations and provide a more stable long-term growth trajectory. By spreading your investments across different sectors, industries, and asset classes, you can minimize the impact of any single investment's performance on your overall portfolio. Getting started. Understanding the basics. Now that we've covered the why, let's dive into the how of investing in the stock market. Here are some essential steps to get you started. Educate yourself. Before you dive headfirst into the stock market, it's crucial to educate yourself on the basics. Read books like The Intelligent Investor by Benjamin Graham or A Random Walk Down Wall Street by Burton G. Malky to gain a solid foundation in investment principles and strategies. Watch educational videos from reputable sources and consider taking an online course or attending workshops to deepen your understanding of investing terminology, concepts, and best practices. Set your investment goals. Clearly define your investment goals. Are you investing for retirement, saving for a down payment on a house, funding your children's education, or building an emergency fund? Your goals will shape your investment strategy, time horizon, and the level of risk you're willing to take. Setting specific, measurable, achievable, relevant, and time-bound SMART goals can help you stay focused and make informed decisions. Determine your risk tolerance. Investing in the stock market inherently carries some level of risk. It's essential to understand your risk tolerance and invest accordingly. If you have a low risk tolerance, you may want to consider a more conservative approach, such as investing in index funds or blue chip stocks with a history of stable performance. On the other hand, if you have a higher risk tolerance and a longer investment horizon, you may be comfortable taking on more risk by investing in growth stocks or emerging markets. Choosing the right investments. With a solid foundation in place, it's time to start exploring investment options. Here are a few popular choices for beginners. Index funds. Index funds are a type of mutual fund that tracks a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. They provide instant diversification by holding a basket of stocks that represent a particular index. Index funds tend to be low cost, making them an excellent choice for beginners who want a hands-off approach to investing. They offer broad market exposure and have historically delivered returns that closely match the performance of the underlying index. Exchange-traded funds, ETFs. Similar to index funds, ETFs are baskets of securities that trade like individual stocks on an exchange. They offer diversification across various sectors, industries, or even countries, providing exposure to a wide range of investments. ETFs can be purchased and sold throughout the trading day, making them more flexible than traditional mutual funds. They also tend to have lower expense ratios than actively managed funds, making them a cost-effective investment option for beginners. Individual stocks. For those who are willing to do more research and take on slightly higher risk, investing in individual stocks can be an option. However, it's essential to thoroughly analyze a company's financials, management, competitive landscape, and growth prospects before investing. Researching factors such as revenue growth, profit margins, debt levels, and competitive advantages can help you identify promising investment opportunities. It's generally recommended to start with well-established blue-chip companies before venturing into riskier speculative stocks. Developing an investment strategy. Once you've chosen your investments, it's time to develop a strategy. Here are a few popular approaches. Value investing. This strategy involves identifying undervalued stocks with strong fundamentals and solid growth potential. Value investors look for companies trading at a discount to their intrinsic value, aiming to buy low and sell high. They analyze factors such as price-to-earnings (PE) ratios, price-to-book (PP) ratios, and free cash flow to determine if a stock is undervalued. Value investing requires patience and discipline, as it often involves holding stocks for extended periods until the market recognizes their true value. Growth investing. Growth investors seek companies with above-average growth potential, often in rapidly expanding industries or markets. These companies may have higher valuations due to their strong growth prospects, but the potential for significant returns can be substantial. Growth investors focus on factors such as revenue growth, market share, and innovation to identify companies poised for future success. However, it's important to exercise caution and not overpay for growth, as high valuations can lead to disappointment if growth slows. Dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you'll automatically buy more shares when prices are low and fewer shares when prices are high, potentially reducing your overall investment costs. Dollar cost averaging can help remove the emotional component of trying to time the market and can be an effective way to build a diversified portfolio over time. Managing your portfolio. Investing is an ongoing process, and managing your portfolio is crucial for long-term success. Here are a few tips. Diversify. Don't put all your eggs in one basket. Diversify your portfolio across different sectors, industries, and asset classes to mitigate risk and enhance potential returns. A well-diversified portfolio can help you weather market volatility and reduce the impact of any single investment's performance on your overall portfolio. Rebalance regularly. Over time, the weightings of different investments in your portfolio may shift due to varying performance. Rebalancing involves adjusting your holdings periodically to maintain your desired asset allocation. For example, if your target allocation is 60% stocks and 40% bonds, but your portfolio has drifted to 70% stocks and 30% bonds due to stock market gains, you would sell some stocks and buy more bonds to realign with your target allocation. Monitor and adjust. Regularly review your portfolio's performance and make adjustments as needed. If a particular investment is underperforming or no longer aligns with your goals, don't be afraid to sell and reinvest elsewhere. Additionally, as your financial situation or investment goals change, you may need to adjust your portfolio to reflect your new circumstances. Consider tax implications. When making changes to your portfolio, be mindful of the tax implications. Selling investments that have gained value may trigger capital gains taxes, which can eat into your returns. Consider tax-efficient strategies such as tax loss harvesting or holding investments in tax-advantaged accounts like 401ks or IRAs. Patience and discipline. Investing in the stock market requires patience and discipline. While the prospect of making quick gains can be tempting, Successful investors understand that building wealth takes time and a long-term perspective. Avoid the temptation to chase hot tips or engage in speculative trading. Instead, focus on developing a solid investment strategy, diversifying your portfolio, and sticking to your plan through market ups and downs. Remember, investing is a journey, not a sprint. By remaining patient, disciplined, and committed to continuous learning, you can increase your chances of achieving your financial goals. Investing in the stock market can be a powerful tool for building wealth and achieving financial freedom. By following the principles outlined in this guide, you can navigate the stock market as a beginner with confidence and make informed investment decisions. Remember to like this video, share it with your friends and family who might be interested in learning about investing, and subscribe to our channel for more valuable content on personal finance and investing. Together, let's embark on a journey towards financial success